Welcome to our weekly USD/CAD analysis. This is your essential guide for the week of December 15th to 19th, 2025. We'll break down the critical market-moving news, dive deep into the technicals, and provide actionable strategies for day traders, swing traders, and position holders. The market is at a pivotal juncture after the recent dramatic slide, and this week is all about consolidation and the battle for control. Stay tuned as we unpack the conflicting signals and identify the key levels that will define the next major move for the loonie. This week, USD/CAD entered a crucial consolidation phase, trading in a tight range after the dramatic sell-off in early December. The market found solid ground near the 1.3725 to 1.3750 support zone, a historical floor, but struggled to overcome resistance at the 200-hour moving average around 1.3800. This price action signals a tug-of-war between recovering bulls and persistent bears. The key question is whether this is a pause before another leg down or the base for a significant bullish reversal. The battle lines are drawn. The fundamental landscape shifted this week. Softer than expected US CPI data fueled bets for more aggressive Fed rate cuts, initially pressuring the US dollar. However, this was counteracted by two major headwinds for the Canadian dollar: collapsing crude oil prices, which fell to multi-year lows, and a surprise softening in Canadian inflation data. This created a complex, conflicting environment, neutralizing the initial bearish USD sentiment and leading to the range-bound price action we observed throughout the week. The bears were halted by a multi-layered defense this week. The most critical zone is the 1.3725 to 1.3750 area, a long-standing support level that has held firm since August. This is the market's line in the sand. Above this, the 100-hour moving average at 1.3768 has turned into immediate support. As long as the price remains above 1.3725, the potential for a bullish reversal remains very much alive. A break below this level, however, would signal a significant bearish continuation. On the upside, sellers have established a formidable ceiling. The primary barrier is the 200-hour moving average, currently sitting around 1.3800 to 1.3805. This level has capped every rally attempt this week. A sustained break above this would be the first major bullish signal, opening the door to the next resistance at 1.3850, and then the more significant 1.3879 to 1.3900 zone. Overcoming the 200-hour MA is the first mission for any aspiring bull. For the next 1 to 2 weeks, our outlook is neutral with a slight bullish bias. The immediate trading range is defined by 1.3750 on the low end and 1.3850 on the high end. The market is likely to remain choppy within this range as it digests conflicting fundamental news. A break above 1.3805 would strengthen the bullish case, while a drop below 1.3750 would shift the bias back to bearish. Traders should be nimble and watch for a decisive breakout. Over the next 1 to 3 months, the outlook is neutral. The entire price structure hinges on the 1.3725 pivot. If this support level holds, it could mark the end of the correction that began at the 1.4139 high, and the long-term uptrend could resume. However, a confirmed break below 1.3725 would invalidate this view and suggest a much deeper correction is underway, with targets at 1.3600 and potentially 1.3538. Patience is key until the market chooses its direction. The market is caught in a fundamental tug-of-war. On one side, soft U.S. inflation data is pulling the U.S. dollar down. On the other, collapsing oil prices and cooling Canadian inflation are pulling the Canadian dollar down. This explains the lack of a clear directional trend this week. The key driver to watch will be central bank rhetoric. Any hints from the Fed about the pace of rate cuts, or from the Bank of Canada about its reaction to inflation, will likely break the current stalemate. For day traders, range trade between 1.3750 and 1.3805. For swing traders, look to buy dips near the 1.3725 support zone with a tight stop, targeting a move back to 1.3850. For position traders, the strategy is to wait. A sustained break above 1.3850 could be a signal to re-establish long positions, while a break below 1.3725 would be a clear signal to initiate shorts. Always manage risk, with a maximum of 2% capital per trade, and place hard stops to protect against unexpected volatility. In conclusion, USD/CAD is in a state of consolidation. The critical pivot point is the 1.3725 support level. The fundamental backdrop is conflicting, creating a range-bound environment. Our final verdict is neutral with a slight bullish bias, but we must await a breakout for confirmation. Watch for a move above 1.3805 to confirm bullish intent, or a break below 1.3725 to signal bearish continuation. Thank you for joining our analysis, and trade safely, trade out there.